Today's webinar is about the role of fossil fuel divestment in financing the energy transition. So what would be the impact of divesting fossil fuel companies, and will it help finance the energy transition? Will it help tackle climate change to do that? And there are three parts to the presentation. The first part is about basically an introduction, looking at the role of fossil fuels in climate change, and looking in particular at the role of the different type of fossil fuels, because we will, and as people know, and as you know, there are differences between the different types of fossil fuels in that regard. The second part is about more specifically about the divestment. Why divest? So what could be the reasons, the motivations for divesting fossil fuel companies? What to divest? So coming back to the different type of fossil fuels, should one make difference and different approaches to the different type of fossil fuels? And also when, in terms of the time horizon, should you invest immediately, or should you give companies a bit more time, for example, to transform their business model and to transition before you eventually divest? In the third part, we'll go into a more practical questions, because the two first parts are, let's say, more theoretical. In the third part, we'll look at some of the practical impacts of fossil fuel divestment policies, and we'll use the example of Paris-aligned benchmark. So, as many of you know, in the EU, there is a label called Paris-aligned benchmark. So, if you want to call your index, your equity benchmark, Paris-aligned benchmark, you need to respect a certain number of technical constraints, which are defined in the regulation. And these constraints include fossil fuel divestments. I'll go into more details. And we'll show some of the counterproductive impacts of actually applying these fossil fuel constraints in portfolio construction in the last part. So we will use that as an illustration of what can happen if you do undiscerning and immediate fossil fuel divestments. So now, the first part, what is the role of fossil fuels in climate change? And first of all, where are we heading today in terms of climate change? You can see here the graph of where emissions need to go for different type of warning paths. And of course, the ideal path, the 1.5 degree pathway, you can see a steep decline in emissions are required before the end of the century. And we basically need to, as you know, have net zero emissions. So emissions net of carbon sinks to be about zero by 2050 if we want to have a 1.5 degree warming scenario. You can also see that the pledged pathways, so this is where we're heading if we just apply the pledges that the different countries have already made, which would result in a warming of about 2.1 to 2.4 degrees. So even if even if countries apply the pledges, or we realize the pledges that have been already made, we are not going to meet the warming objective of the Paris Agreement. We'll be above 2 degrees. And if we just keep going on as we are today, we'll be heading more towards 3 degrees warming. So quite far away from the goals of the Paris Agreement. Any kind of Paris-aligned strategy or net zero strategy, which are basically equivalent terms, are extremely ambitious. We need to do much more than we have already committed to do if we are to achieve those goals. So any kind of investment strategy that claims to be Paris-aligned or net zero is an extremely ambitious claim. Now, there isn't a single way to achieve net zero emissions. These graphs are taken from the IPCC report from 2018 with different technological options. And in particular, when it comes to carbon sinks could be natural. So, for example, linked to agriculture or reforestation, or you have technological carbon sinks or carbon capture technologies. So depending on the degree of natural or technological carbon sinks, you can have different pathways towards net zero. You can have higher absolute emissions if you have more carbon sinks, of course. So there isn't a single way to achieve net zero emissions. There are different technological pathways. But of course, the carbon sinks could be reversed. So one problem with natural carbon sinks is that they can be reversed if you let's say, grow, remove or burn the forest or cut it down again at a later stage. And technological carbon capture technologies are many of them a bit uncertain for the time being, so they can also be reversed or at least be much more difficult to implement than what had been foreseen at the current point in time. Now, if I go to the next slide here, these are basically a graph taken from the International Energy Agency's net zero emissions scenario, which came out in 2021. And you can see here that in the coming decades towards 2050, the total energy supply is about constant. So this is total energy supply, and actually if you just look at electricity supply that will be required in these net zero scenarios, we actually need more electricity and we need a constant level of total energy supply. But you can see big changes in where this energy comes from, and in particular you see an extremely steep decline in coal, so that's the bottom line, the brown line, slightly less steep but still quite steep decline in oil, and then also a decline in natural gas usage. So the fossil fuel the source of energy coming from fossil fuels, you will see rapid declines over the next 3 decades in order to reach these net zero scenarios. When it comes to, so not only do we need to, let's say, defossilize the energy, but we also need to reinvest in green energy. So we need in particular lots of investments in green electricity. As I said, the constant energy supply and the increased electricity output that we need is and will require huge investments in a new infrastructure in particular. So can you see these numbers here are again taken from the International Energy Agency, and you can see, for example, between the current level and the level in 2030, so that's at least a tripling of required investments in green electricity and in the coming few years. So lots of new investments are required, and it means that any kind of investment strategy that claims to be net zero or climate friendly will also include not only divestment but also reinvestment in greener type of energy sources. Now, now I'll talk a little bit about the differences between the different type of fossil fuels. And a lot of the divestment policies, a lot of investors have already started divesting from coal and tar sands. Let's say the two top culprits in terms of fossil related to climate change are, of course, the usual suspects are coal and tar sands, and there are good reasons for that. When it comes to coal, the main problem is, as you all probably know, is that coal requires about twice the level of greenhouse gas emissions for the same level of energy output or electricity output as natural gas, for example. So twice as energy inefficient as natural gas. But perhaps a little bit less known, coal is also the source of a third of methane leakages linked to fossil fuel production. So it's not only about the CO2 when it comes to fossil fuels, there are also a lot of methane leakages linked to the production of fossil fuels, which represent about 20% of the total greenhouse gas contribution from fossil fuels is actually linked to methane leakages. And a third of that comes not from, let's say, leaking pipelines, but from coal production. So coal is also a large source of methane leakages. When it comes to oil sands or tar sands, which are also often called, the main problem is the high level of energy that is required to produce and refine oil sands or tar sands. The estimates vary a bit between the different type of technologies and the different pits, but let's say that the range is from 56 to 156% higher greenhouse gas emissions when it comes to production and refining than traditional or conventional sources of oil. So let's say on average about twice the level of emissions linked to production and refining compared to conventional oil. And that is also why tar sands is often included in divestment policies. Now, and if you take, for example, the one well-known investor, the Norwegian government pension fund, they have an explicit exclusion policy that mentions coal. So coal is explicitly mentioned for divestment, but they also, in practice, also divest from tar sands with the criterion they call unacceptably high greenhouse gas emissions. So they have a, let's say, a criterion which is not quantitatively defined, so they haven't set a threshold, they haven't defined a specific product, they just have a general criterion linked to unacceptably high greenhouse gas emissions, and the only companies which are excluded based on this criterion are actually 4 Canadian oil sand companies. So basically, coal and tar sands are, as you are aware of, the top 2 types of fossil fuels, and the first 2 types of fossil fuels that are included in a lot of divestment policies. Now, when it comes to natural gas, some would see it as a part of the problem, and others would see it as a part of the solution. There has been a lot of debate and controversies around that. And this is because, as I said, coal is twice as inefficient as gas, meaning also that gas is twice as efficient as coal in terms of producing electricity. So if you switch electricity production from coal to natural gas, you will see a steep decline in emissions. So you could argue then that it's at least a temporary solution to the problem is to switch from coal to gas. And this is, in particular, if you take the EU taxonomy regulation, and there was a lot of controversy about that, as I mentioned, basically under some conditions, investments in power plants fueled by natural gas were actually considered as part of this sustainable activity under the EU taxonomy regulation. But under the condition in particular that the new power plant was only built when a coal-fired power plant was shut down, and also that either you had the carbon capture technologies included, or that the power plant was to convert rapidly and by no later than 2035 to purely renewable energy sources. So basically just a transition for about a decade, and as a substitution for coal-fired power plants. Then you could, and that at least that is what the EU taxonomy in the end decided, it could be considered a sustainable activity. But one problem with this switch, so switching from coal to gas, is of course again the problem of methane leakages, which could be either deliberate, so for example incomplete flaring or deliberate venting, but also fugitive emissions. It remains a bigger problem, and it's quite a difficult problem to estimate. It's a bit the same as with crime, fugitive emissions. You don't have always good numbers and good data about it, but it is, under any circumstance, a huge problem linked to natural gas exploitation. And for example, if you take the Nord Stream pipeline that broke a couple of months ago in the Baltic Sea, even a few days of leakage from that pipeline represented the same greenhouse gas emissions as the entire emissions from a country like Denmark over 1 year. So you can, of course, leakages are a significant problem due to the warming potential of methane. Now, when it comes to the last fossil fuel I wanted to talk about, because this already mentioned the issues around the coal to gas shift and the taxonomy regulation. So a few words about oil. Oil in the different scenarios from IPCC has a less steep decline than coal. So coal has a decline of about 95%, whereas the median decline in 1.5 degree scenarios for oil is about 60-65%. And the reason for that is that, in particular, some types of oil usage is much more difficult to substitute than, for example, gas in electricity production. When it comes to transportation, one can note, for example, that for long distance transport, so lorries and shipping, etc., it is feasible in the end to substitute it, but it's going to be more difficult. For private cars, in Norway, where I live, actually, in 2022, more than 80% of new private cars that were sold in 2022 were electric cars. So it shows that even in a country where it's cold, so, the cold weather makes batteries less efficient, or they lose power more quickly in cold weather. And in a sparsely populated country with large distances like Norway, some people would argue that it's difficult to use electric cars because you need more charging stations, for example. But as the numbers show, if you throw enough money at the problem, and in Norway you've had long consistent subsidies for electric cars, so if there is a political will and if you throw enough money at the problem, it is feasible to substitute fossil fuel cars to electric cars quite quickly. For long distance transports or airlines and lorries in particular, it will take a bit more time. So that's why the decline is a bit less steep than for natural gas in particular. And oil is also used in other industries, in particular in the chemical industries, and also for road construction, for example. So there are some usages of oil which are also difficult to substitute. So clearly, we will need to use less oil, but it's not going to be almost eradicated, as is the case for coal in any kind of net zero scenario by 2050. Now, so in the first part, we just show that basically fossil fuel is a huge part of the problem when it comes to climate change. It's the main source of greenhouse gas emissions. And we saw a hierarchy between coal, tar sands, conventional oils, and natural gas. In this part, we'll look at the role of divestment more specifically. So why divest? What to divest in terms of the different type of fossil fuels, and which time horizon you should have in mind. Now, when it comes to divestment, some people claim that divestment is just a passive bystander approach, that basically if you divest, you just hand over ownership of the company from one investor to another investor. So, and some people will claim that this transfer of ownership has no impact. Sometimes it's even claim that the impact is negative, because you might, for example, transfer the ownership from the public markets where there is a lot of public scrutiny, more transparency. You could transfer the ownership over to private hands where there's less transparency, less scrutiny, and the owners might just be less scrupulous about climate change. So by transferring, let's say, from public to private ownership, you might actually do more harm than good. But as we would argue, there is also a positive contribution linked to divestment, in the sense that if you sell companies, it will have an impact on the cost of capital. So divestment increases the cost of capital of companies, so it hampers the ability of companies to grow when you divest from them. So if you don't want oil and gas companies to facilitate the development of these companies, divestment can have an impact through the mechanism of increased cost of capital. There are some academic studies that look at this impact, and there are some empirical. So theoretically speaking, it's easy to understand that basically if you increase the supply of something, you decrease the price of something. So if you decrease the price of a stock, that is equivalent to saying that you increase the cost of capital. But there are also some empirical studies that have been made that show this not only theoretically, but empirically. One paper in particular by Dorian Weber showed that it's an event study. So they look at fossil fuel announcements. And they show that in these 24 different events that they study, they show significant abnormal returns. So that means basically a shock to the price of stocks for these fossil fuel divestment announcement. And they show that this effect comes from two different sources. One is, as I said, when you sell, you shift the supply of the stock, so you shift its price. But by announcement, sometimes these announcements are mere announcements. So the actual selling could have already occurred. So you can announce the divestment after the fact, after you've already divested. So this is some large investors do that because they know that if you know, or at least if you think that the price is going to decline, it's better to announce it after you've already sold the stock at a higher price. So this is, for example, what the Norwegian government pension fund does. All the exclusion decisions that they publicize are made after the divestments have already been made. But at least they show that the mere announcement, whether it's before the fact or after the fact, can also have an impact on the price. And this is through not the shift in supply and demand, but through the perceived riskiness of that stock. So when investors announce that the perceived riskiness, the risk premium attached to the stock will change in the market, and it can have an impact on the price. And to illustrate that, one of the events that they study is from an endowment fund linked to the Oxford University. So it's, let's say, a kind of prestigious investor. It wasn't a big fund, and the fund had already divested. So the announcement in itself didn't really have any impact on the actual selling that was going to happen, because it was such a small fund that had already invested. But when, given the prestige and the academic credibility of the Oxford linked endowment fund, it still had an impact, an observable impact on the stock price and on the cost of capital. An even more interesting study was published by Rollader and al. In 2022. In 2021, they published the first study when they looked at the investment impact of US mutual fund. They extended that to European mutual funds in 2022. And in both cases, they show that when you had what they call decarbonization trade, so significant decarbonization of these mutual funds, they observed not only a stock price decline immediately after, but they showed that this stock price decline was permanent. So it wasn't just a decline which was reversed quickly after. It was, let's say, a permanent decline in the stock price, at least over the subsequent 2 years. And even more importantly, they showed that 2 years after the divestment had actually occurred, the companies had reacted by reducing their carbon intensity. So the increased cost of capital that they were facing led them to also act and reduce their carbon intensity. So it shows that, or at least these two studies show that divestment can have an impact on cost of capital, and that the changing cost of capital makes companies change their business model. And in particular, they decarbonize their activities after these cost of capitals have occurred. So there is some empirical evidence that divestment actually works through the means of cost of capital. It's been documented empirically. Now, this, nevertheless, in a more theoretical setting, so there have also been some theoretical papers going all the way back to Heinkel et al. From 2001, and also some papers from 2014. Different, let's say, theoretical models which show that it's quite intuitive, of course, that if a lot of investors, if a critical mass of investors divest, it will have an impact on the cost of capital. But of course, if it's just a minimum marginal investor, at least if it's not a well-known one like the Oxford Endowment Fund, it hasn't an impact. So you have to reach a certain critical mass. The critical mass has been estimated at, let's say, between 8 and 20%, depending on the different type of models. So one question one could ask is, have we empirically already reached the critical mass of about, let's say, 10 to 20% of investors that already divest from fossil fuels? So the first table I show here is taken from the numbers, the biannual review of the Global Sustainable Investment Alliance, and they show that basically around, depending a bit on the region, in developed markets, about 40%, 35% of assets in total apply some type of ESG investing strategy. So about, let's say, 30 to 40% of total assets under management already incorporate some type of investment strategy. But in the same report, they also show that the most popular, the most widely used type of ESG strategy is ESG integration. And ESG integration doesn't necessarily mean that you divest. Whereas, for example, if you apply ESG policies such as negative exclusionary screening, which is the second most widely type of ESG strategy, you will, as the name says, you will include some type of screening, but it's not the most widely used strategy. It's the second most widely used. And also, of course, all investors that apply negative screening don't screen out the same stocks. But given these numbers, given, let's say, the starting point of about 35–40% of total AUM having some type of strategy, the second most widely used strategy, including some type of screening, and coal and tar sands in particular being widely applied criterion, it's not unreasonable to believe that today 10 or 20% of total investors have already excluded coal companies in particular. So this will also mean if you just look at the stock prices of coal companies, and also the way in which a lot of, let's say, utilities, for example, are selling off their coal activities, it's credible to believe that we've already reached the critical mass of investors that divest at least from coal. Probably not from all type of fossil fuels yet, but at least from some type of fossil fuels, it's already been empirically achieved at this point in time. Now, some investors in particular, for example, if you look at some of the recommendations from the Net Zero Asset Owner Alliance in the document, the Net Zero Target Setting Protocol that they published in 2021, they reference in particular one paper by Köbel et al., where they discuss the effectiveness of divesting strategies compared to engagement policies. So having an active ownership or active stewardship approach instead of divesting. And in this paper that the Net Zero Asset Owner Alliance references, they basically tend to show that engagement is more effective than portfolio construction or divesting. So that's at least what they try to show. And they claim that there is a lot of, let's say, academic evidence behind that. The problem is that this paper is a kind of a meta study where they reference at least 5 different papers that look at the effectiveness of engagement. But there are a lot of, let's say, caveats to these papers. In particular, for example, some of these papers show that engagement in the E domain, so engagement on environmental issues, tends to be less effective or have lower success rates than engagements around social or governance issues. So, of course, when we are talking about climate change, it's not comforting to know that engagement is less effective for environmental issues. Another issue is that basically if you engage and you ask companies to improve transparency, so in particular a lot of engagements just ask companies to publish environmental reports or climate risk reports, for example. If you just ask companies to publish reports, you will be more, the likelihood of success is of course higher than if you actually ask them to change their completely business models or change their technologies, because that is much more expensive. Publishing a report is quite cheap compared to changing your business model or investing in new technologies. So the success rate is also higher, but the impact is also much lower. If you just publish a report, it doesn't really doesn't necessarily mean that you have actually done anything about emissions. So it's not reassuring to know that success rate is 2 or 3 times higher than if you ask for something which is more material in the sense that it requires more costly investments. Another problem is that some of these studies are, when they measure success, so they measure the successful outcomes of engagement, some of them are just based on measuring success by improved ESG ratings. We've talked about earlier in other webinars and papers about how unreliable ESG ratings are. For example, the correlation between ESG ratings from different providers is only about 0.5. So there's a lot of, let's say, noisiness in this data. And also some papers have shown that ESG ratings tend to always increase. Basically, ESG rating agencies are a bit reluctant to lower ratings because they know that companies will be less satisfied. So it's easier to just continue increasing these ratings. So if you make a study that is based on increases in ESG ratings, this happens whether or not you engage. These ratings tend to increase anyway. And last but not least, some problem with these studies is that they are based on there's no good public database about engagement. So some of them just look at the effectiveness of one specific investor. So some investors have been engaging for a long time and have good databases, but it's not clear to what extent you can just say something general about the effectiveness of engagement based on the experience of one investor. So these investors might be very good at it. It doesn't mean that all investors in general will be as successful as these, let's say, pioneers or these specialists in engagement. So basically, I show that there is some reason to believe that divestment can have an impact through the increased cost of capital. Some reasons to believe that engagement can also be successful, but with some caveats. The two together, but the way we view it is that engagement and divestment should be linked together. Basically, if you want to have a credible engagement policy, you need to be able to divest at some point. So, for example, if you set the milestone for a company, the company needs to know that if the milestone is not reached by the predefined deadline, there will be a possibility of action at some point in time. If you have no possibility of action at any point in time, you're just making an empty threat, basically. So if you want to have a successful engagement policy, you also need, at least over time, to be able to divest. So instead of seeing these two strategies as separate and even competing approaches, so that you have to choose between one or another, you should instead see them as synergistic and intertwined methods to achieve impact and linked to the two together. Now, when it comes to divesting from fossil fuels in particular, there are different reasons or different logics you can have behind that. You can divest also from a purely financial risk assessment perspective. And in particular, you could divest due to stranding risk. So the risk that the fossil fuel assets, the coal mines or the oil reserves that are sitting on the balance sheet of companies at some point will not be exploitable because the carbon prices have increased so much that it's not profitable to exploit them anymore. So there is a stranded risk for fossil fuels in general, but clearly the stranding risk is higher for coal than for natural gas, for example. So some studies have shown that if we are to reach a 2-degree scenario, for example, we need to leave 80% of coal in the ground, but only 20% of oil reserves. So in terms of, let's say, the magnitude of stranding risk, it is higher for coal. But also if you look at the time horizon, the IPCC, for example, they say here that coal assets are projected to be at risk of being stranded by 2030, whereas for oil and gas, it's more by 2050. So both in terms of magnitude and time horizon, the stranding risk is more acute for coal than for the other type of fossil fuels. Now, so that is, you could argue in favor of divesting from a stranded asset risk perspective, whether or not this stranding risk is reflected in stock prices. So if it's not reflected, there is clearly a good reason to divest. But even if it is reflected in prices, you could still have, let's say, potential loss that would be just exceed the risk-bearing capacity of some investors. So even if it is reflected in the price, in some scenarios, the loss would still be higher than what is bearable by some investors. So you could argue in favor of divesting for that reason. But you can also argue in favor of divesting as a kind of an insurance premium that you pay more globally. So investors basically have, or most investors have liabilities, and at some point in time, the ability to pay these liabilities comes from the GDP output. All investors in the future basically need the economic output in the future to pay for these future liabilities. And some studies have shown that basically the cost to economic output, the cost to GDP growth, would be quite minimal even to reach 2-degree scenarios. So from the IPCC, they cite the IPCC report basically cites a different type of economic studies that have been done and show that the cost to GDP growth would be only about 4 to 9 basis points per annum to reach a 2-degree scenario. So it's extremely modest cost to have a 2-degree scenario. And this is without accounting for the benefits. So you just take the cost side of it, and you can have the benefits also, for example, from lower climate adaptation costs. So, for example, if we have higher warming, we will also need to spend more money on climate change adaptation. And if we pay for having a lower warming, we'll need to pay less for climate change adaptation. So even without including in the cost benefit analysis these benefits, the cost is only about 4 to 9 basis points. So it's a very modest cost to avoid the risk. And this is the mean risk or the mean cost. But in some circumstances, for example, if we let the warming run wild by above 3 degrees, basically the whole economic output would be hurt. So the whole basis on which investors are able to pay their liabilities could be wiped out in some of the worst scenarios. So if you want to avoid some of the, let's say, the worst case scenarios, it's a small cost to pay 4 to 9 basis points per annum to avoid such extreme risks. Now, there are 2 net zero investment frameworks, what I call net zero investment frameworks, that were published in 2021. There was the target setting protocol that was published by the Net Zero Asset Owner Alliance, and there is the Paris Aligned Investment Initiative, which also published a net zero investment framework. So there are 2 well-known net zero investment frameworks, which both have a grasp with this question of fossil fuel divestment. So if you take the Paris Aligned Investment Initiative net zero investment framework, they basically give 3 reasons for divestment. One is divesting for an activity that is, let's say, incompatible with any type of credible net zero pathway. So this would, for example, be coal exclusions, because basically coal is incompatible with net zero pathway. We saw that basically by 2050 we need to get rid of 95% of coal usage. That is a good reason for divesting. The second argument they use in favor of, or that could be used for exclusion, is a financial risk assessment. So that is the stranding risk. And the third one is, as they call it, the consequence of escalation following engagement. So basically, if you start engaging with a company and you basically, for example, ask the company to change the technology or to sell off coal assets by a certain point in time, and this would be, for example, 2030 in developed markets and 2040 in emerging markets. If that doesn't happen, if there is no action or if there is no reaction from the side of the company, that could be a good reason for divestment. Now, the Net Zero Asset Owner Alliance also published a specific paper on coal, more specifically. So clearly, there is in these net zero investment frameworks a role to be played by fossil fuel investments, which is acknowledged. Now, The science, I'll maybe go about this quickly in the interest of time. The Science-Based Target Initiative, they had actually approved targets from some integrated oil and gas companies, but they actually recalled those approvals, and they are still in the thinking box of how oil and gas companies could set themselves targets which would be considered science-based targets. So they basically retracted some of these science-based target approvals for oil and gas companies, and they're still thinking about what should be asked of them. But clearly, let's say the outline is a conversion to renewable energies or to carbon capture services in particular. Now, so what we basically showed in the second part is that there is a role for divestment, but that this divestment needs to be discerning. So you should probably not divest from coal and tar sands at the same time horizon as you divest from gas, for example. Gas, you could put conditions such as the shift from coal to gas, for example. So you could have more discerning strategies that look at different type of technologies and different time horizons to justify divestment. And as a contrast to discerning and escalating fossil fuel divestment policies, we'll now in this final part look at compliance with the Paris-aligned benchmark constraints. So as I said, this is a regulated label in Europe, and technical requirements to have that label includes a number of fossil fuel exclusion criteria. Now, in particular, there are two types of criteria included in the PAB constraints. So one is based on revenues from coal, oil, and gas. And as you see in the table here, there are different thresholds for revenues depending on the different type of fossil fuels. So the revenue thresholds are extremely strict for coal, so it's just 1% of revenues. It's 10% of oil and 50% of gas. So at first glance, this looks like, let's say, a discerning policy, since it makes a clear difference between the different type of fossil fuels. The second criterion is linked to electricity generation. So if a company generates electricity, or more than 50% of the revenues of the electricity generation comes from electricity that produces more than 100 grams of CO2 equivalent emissions per kilowatt hour. So if basically this means that if more than 50% of the electricity that the company produces is based on fossil fuels, then the electric utility company should also be excluded. So one is based on revenue thresholds from different type of fossil fuels, and one is based on having more than 50% of electricity production coming from fossil fuels. So these are mandated in the PAB constraints. So if you want to call your benchmark in Europe PAB, Paris-aligned benchmark, then you need to basically divest from these companies. But what we show in this table is that if you divest from these companies, you also divest from producers of renewable electricity. And in particular, if you look at the column for emerging markets, if the first criterion linked to fossil fuel revenues, you take away almost 40% of renewable electricity production is taken away at the same time. So yes, you take away producers of fossil fuels, but you also wipe out almost 40% of renewable electricity production in emerging markets at the same time, because these companies are basically the same companies. The companies that produce fossil fuels are also big investors in green electricity or renewable electricity. This is also the case for the utility criterion in developed markets. So all in all, 36% of renewable electricity production is basically wiped out if you apply the fossil fuel criteria of Paris-aligned benchmarks. And this shows that basically, yes, you avoid fossil fuels, but you also take away a lot of renewable electricity generation. So it means that basically the cost of capital of these companies which are investing heavily in green electricity is going to increase. So it means that the shift, the transition toward green electricity might actually be more difficult to achieve because the cost of capital for green electricity production actually also increases through these companies. So what you might think of as something positive because you get rid of fossil fuels is actually going to be negative because you're going to make life more difficult basically for companies that invest in green electricity, because these are the same companies in many cases. A second problem is linked to a constraint around sector weights. So we published a study in 2021 around greenwashing, and we show that a lot of climate or portfolio construction methodologies that are usually applied in climate benchmarks or climate indices or climate strategies more generally, they typically apply one of two methodologies. One which we call tilting, so typically starting with the cap weighted benchmark and tilting up and down, over and under weighting depending on climate inputs, so in particular carbon intensity. Or you have other strategies that use optimization techniques, so you basically ask an optimizer to reduce the carbon intensity of the portfolio and you put some constraint on the tracking error. So you minimize tracking error with carbon intensity reduction constraints, or you tilt up and down relative to a cap weighted benchmark. So these are two very common ways of building climate indices. When you do that, if you don't put any sector constraints, what the table shows here is that the weight of the electricity sector, so the weight of electric utilities, is reduced by 80 to 90%. So basically, you wipe out all the funding for electric utilities, so you make the cost of capital for electric utilities higher. So this is, of course, counterproductive when it comes to their ability to invest in green electricity, which we show that these investments need to triple by 2030. The problem with the PAB constraints is that they actually include a greenwashing constraint where you're not supposed to underweight what they call high climate impact sectors in aggregate. So in aggregate, to have the PAB label, you're not allowed to underweight PAB, to underweight high climate impact sectors. The problem is that this is high climate impact sectors in aggregate, so, and this represents about 2/3 of the market. 2/3 of the total market cap is considered high climate impact, and within that, you're allowed to play around with individual sectors. So even if you put the PAB constraints in terms of sector weights, you see here the numbers are basically unchanged. They are not binding when it comes to avoiding the problem of underfunding of electric utilities. So PAB constraints, first of all, lead to divesting from companies that produce large share of electricity or green electricity, and you also typically underweight electric utilities more generally. Now, a last aspect that I wanted to show is that, of course, if you divest from all fossil fuel companies immediately, as is the case for PAB benchmark, you're also going to have an investment strategy that is very dependent on oil prices. So, for example, to illustrate this point, we look at two different versions of what we call the CIC indices. So these are scientific betas, climate impact consistent indices. So we have a range of climate indices which are within sectors purely weighted by climate inputs. And in the standard version, we have some fossil fuel exclusion constraints, but which are merely focused on coal and tar sands. So in the standard version, we exclude coal and tar sands companies, whereas in the PAB compliant version of these indices, we also apply the other fossil fuel divestment criteria that I mentioned. So basically, the difference here is about oil and gas exclusions. One does not exclude oil and gas, the other one does exclude oil and gas. And if you look at the numbers here, we just built a regression using a two-factor model. So the first factor is just the market premium, and the second factor is the oil beta. So basically looking at to what extent the return on the index is dependent on the return of a portfolio that is long and short oil stocks. And And what we show clearly, if you see the standard version, does not have a statistically significant exposure to the oil beta, whereas the PAB version, which does exclude all oil, gas, and also coal companies, it is significantly exposed to the oil beta, meaning that it benefits. It has a positive outperformance when oil prices are falling, and it has and vice versa. When oil prices are increasing, the index tends to have an underperformance. So clearly, these policies are risky from a financial perspective, in the sense that you have a relative risk linked to the evolution of oil prices. And over the last, and this is should be taken into account when you assess the performance of a lot of climate strategies over a long period. So this is numbers here from 2013 up to the last summer. Basically, over that whole period, where on the long-term trend was of falling oil prices, these climate strategies tended to outperform. So a lot of climate strategies have been sold on the premise of backtracks or track record or backtest track records, which were outperforming, and a large part of that outperformance actually came from a negative exposure to the oil beta. But of course, for example, in the period, the first half of the last year in particular, when oil prices or fossil fuel and gas prices also in particular rebounded, in particular due to the war in Ukraine, these investment patterns reversed, of course. So you need to be aware not only that you're taking on, let's say, a relative financial risk, but also when you analyze the past performance of these companies, that you account for how much of that past outperformance backtest came from the oil price beta of these strategies. So I'll skip the conclusion. The conclusion is, we'll not skip it, I will just say it in a few words. We clearly believe that there are good reasons from divesting immediately from coal and tar sands, but we believe that you should be more discerning and more time escalating or more progressive when it comes to oil and gas exclusions, to do that more over time, to allow, because some of these companies are already significant investors in renewable energies and renewable electricity in particular. So some of these companies are already on a transitioning path. And if you divest from all of them at the same time, you're taking away the incentive of these companies to go towards that path. So you need to have a discerning policy between different oil and gas companies, between different type of fossil fuels as well, and give some of these companies a bit more time to divest. And we saw some of the practical implications of having an undiscerning and immediate fossil fuel divestment policy, such as the one of the PAB constraints. That could have some counterproductive impacts.